Hey guys, it's Maynard. We tried this last week, so we're going to try it again. It's a quick roundtable with a handful of TPHers, and this week we're really excited to add Dr. Ken Medlock from the Center for Energy Studies over at Rice University. He's a longtime friend. Thanks for joining, Ken. I've got Mike Bradley, our energy equity strategist, and also on the phone we've got Matt Portillo, co-head of research, and Colin Fenton, our head of TPH Commodities. Guys, let's jump in real quick. Mike, it's a week since we did our last video. Oil prices are down since then. We've had a bunch of zigs and zags. Is anything new?
I think if anything's new, I think people's perception of where oil prices are going to go is a lot worse today. I think most people were hoping that we would have a rebound. I think most people now are thinking oil's going to be in the low 20s. We're going to go to cash cost. There's going to be shut-ins. That's what's changed in the last week. So sentiment's really gone negative.
Do you buy all that? I've seen quite a lot of that sentiment that we're going to have to get into the 20s.
Yeah, if OPEC keeps up its production, demand stays where it's at, it's going to happen.
Colin, we've got you on the phone. You're looking at demand. You're looking at a lot of different metrics. What are you seeing? What do you think? How bad does it get?
Yeah, I think first of all, it's useful to remember that there have been 3 successive demand shocks here. The first was the very warm winter in the Northern Hemisphere. It's been about 11% cumulatively warmer than normal in the upper Midwest, 10% U.S.-wide. That's taken natural gas demand down by about 7% year over year for heating. Seen a pretty sharp hit on the liquid side. And then, of course, the second demand shock was the first emergence of COVID-19 in China. That shut down major refinery operations at Sinopec and PetroChina to the tune of a 17% hit year over year in February. But it's important to note that once China started coming out of that, there was a pickup in refinery utilization, which we can see at the independents, and also in other measures of economic activity. What really changed in the past week, and I mean literally like that weekend when prices really started to buckle, was what's now being called the global shutdown of 2020. And if you look at airline cancellations from March 8th through today, there's really just this stunning upsweep as we've seen the entire world shut down, whether we're talking about the restaurants, the cafes, people trying to get back from spring break. And just to put a number on it, in the past 10 days, global cancellations now number 58,942. To put that in context, it is larger than all cancellations by large commercial carriers in the year 2016.
So one question. I guess the stat I saw is that the daily oil demand, we're off 7 million barrels a day. Is that the right number?
Yeah, I think what's important to keep in mind about that is people tend to gloss over duration. And so they'll take a number that's literally for a day or for a week and then apply it to the entire year. So we're at the point of maximum hit right now. But as we get into the later part of the year, not only will we see that number rapidly come back towards zero, we're likely to have demand growing by the third quarter.
So one thing, Matt, I know we're all watching the screen, and some of the gas names have had a little bit of a lift. There's a correlation between being green and being gassy, at least at a glimpse. What do you make of that? Is that real? Is the gas rally coming? How's that trend going?
Yeah, I think it's really a tale of two cities for us, Maynard. In the near term, we're still quite concerned for gas fundamentals as we head into the shoulder period, especially with some potential risk for LNG demand. So that may send the front end of the curve a bit lower. But one thing that's really kind of screaming through on our model at this point is that associated growth in the U.S. is set to decline and potentially set to decline in a pretty significant way over the next 2 years. And that generally has weighed on the gas market since kind of 2015, 2016, when we saw the last recovery in gas prices. So as we look out to 2021, we're definitely getting a lot more constructive, and we are seeing, I think, clients as well start to put money to work in some of the dry gas producers that tend to have good balance sheets and are able to actually start to generate free cash flow as that commodity curve improves.
So, Ken, let me jump to you, because you're when we've done videos in the past and you've been a speaker at a lot of TPH events, you're often talking about great big picture issues, population growth, energy transition, all these kinds of things. What's happening at your place right now? What are you spending time on? How are you kind of recalibrating? What's the best place for you to spend time on? What are the constituents that you work with? What do they want to hear from you?
Sort of a glimpse through the veil of uncertainty. I think that's what everybody's sort of striving for. There's a few things that are adding to this, and Colin mentioned the demand shocks, and I think one of the things that's really important that distinguishes this time from previous sort of oil price episodes is the COVID-19 experience really is a fear-driven demand shock. So it's very different than a financial crisis or something of that ilk. And you're seeing, interestingly, the same sort of policy playbook being unfolded in response to this economic malaise. And the interesting thing about that is, injecting liquidity, dropping interest rates. Now there's discussions about sending a $1,000 check to every household in America. I mean, consumers aren't going to run out and spend that, right? In fact, what they might do is consolidate debt, refinance mortgages, but what that's going to do is it's going to open up free cash flow. Once the fear sentiment drops, you're going to see this pop in demand like you haven't ever seen, I think. But
it's funny. It does seem like we're going to the same toolkit we always go to. The 2 days that the market, when we had interest rate cuts, were disastrous days. I'm not saying that's correlated, but it does feel like we don't have anything in the toolkit necessarily to really deal with this, or is that unfair?
It's a different experience. The economic toolkit, I don't think, is actually the right toolkit here. This is really more about providing services to the global constituency, not just citizens in the United States, that alleviates fear. That's really what it boils down to. You're starting to see some elements of that with the way, with Health and Human Services responses, stuff like that. But until that really is allayed, this is going to go on.
What do you? Because I know at Rice, you guys have a lot of great relationships with in the Mideast, etc. We kind of all know. We think we know why the Russians and the Saudis, got us into this, or at least their contribution. Are their attitudes changing as they watch all this coronavirus stuff, or are they just in their own world and they're not connected?
No, they're connected. As a matter of fact, and they're acutely aware of what it means, not only globally but also in their own communities. I mean, you're seeing social distancing, school cancellations. All these things are going on in those countries as well. So it's happening everywhere.
Well, I guess one of my question is, it seems like at some level they'd say, gosh, doesn't the world have enough problems? Can't we, isn't it time to get back to the table, with their global citizenship hat on? Maybe that's wishful thinking. Yeah. I'll take the prize for wishful thinking today.
I think
Ken is laughing at my question.
It's a fair question. No, it's a fair question. I think what they're hoping for is, to be honest with you, some sort of positive demand response. But at the same time, trying to re-exert themselves as the 800-pound gorilla in the oil market, just to be honest with you. Because in a lot of respects, I mean, you think back to the 2003 to 2008 time period when prices, everybody said OPEC lost control of the market, right? And we've gone through those periods time and again, and with Iran being hampered by sanctions, with Venezuela being offline, that really beget the need for Saudi Arabia to bring Russia to the table, and that's a tenuous relationship at best, and I think that's kind of what you're seeing at the root of all this.
So Matt, we've been hearing from a lot of companies in the last few days. There was a handful today. Over the last, since last Monday, there have been quite a lot of cuts. Any themes from those spending CapEx cuts? What's your take on all of that?
Yeah, I think the positive feedback from investors that we've talked to so far is that the industry this go around is being very responsive to the lower crude price and is aggressively adjusting capital programs, which is a very different outcome from 2015 and 2016 when there was a viable capital market. And ultimately, I think the healing process here will be the supply declines that kick in 2020 and 2021 that potentially set up for a more constructive 2022 plus commodity backdrop. So I think it's a healthy dose of capital cuts that are coming through. At the moment, we're expecting about a 40% reduction in spending from 2019 to 2020 and an additional 15% reduction in 2021. That being said, as crude prices continue to trend lower, we could see spending cuts coming further. So the name of the game right now for investors and the names that they're looking at are basically the survivors that will move through the next 2 years with limited amounts of balance sheet destruction, and ultimately companies that can drive as we get back into maybe a bit more of a normalized market as the spare capacity from OPEC kind of dwindles away.
So that is something, I think that's actually a really good point. I know from conversations from folks that are in the Middle East in particular, there was a realization that there seemed to be a lack of discipline in capital spend in the U.S. upstream, and the noise and the rhetoric began to really mount that there was going to be a wave of bankruptcies that were imminent. And so in many respects, I think what might be part of what's driving what we're seeing is an acceleration of that. So in a lot of ways, this is Darwinian, because you're going to thin the herd, but the asset doesn't disappear. The rock is the rock. And so really what's going to fall out of this at the end of the day is those that are healthy, when they come out the back end of this, they'll be able to potentially acquire acreage for pennies on the dollar and even grow their business portfolio. So it'll be interesting to see how this unfolds.
So speaking of announcements, Aramco just had a call. Mike, what would you tell us about what Aramco's saying?
Well, it's 2 days ago they had their year-end wrap-up.
Yeah,
and pretty much on point that, hey, we're going from 9.7 million to 12.3 million barrels a day, and we have the capacity to stay there for quite a bit of time. We're the low-cost producer, throwing out how much their lifting costs, total cost is around $8. But, they said they're going to do that through April, but they held out. They haven't obviously put the May, OSPs out there as of this point. There is some wiggle room for them, but within the next couple of weeks, they're going to start to have these OSPs out there. So it feels to me like they're sending a message on that call that we are going to put oil on the water. We can withstand low prices. Hey, you guys at Russia, U.S. producers, take note of this. Now, whether that happens for the next 3, 4, 5 months, we shall see. But it does seem like that's the message they're trying to send to the world.
What do you guys collectively think if you said, what's the median guess of how long the Saudis will behave like this? What's the median guess in the market about how long they do this? Is it 6 months? Is it 9? Is it 3?
I'd say consensus is that they're going to probably do this for at least 3 to 4 months and see where it gets them. But like I said, they are kind of hanging that thought out there that things could change. It doesn't feel to me like they're going to change it. That's probably a little early, but guess what? They have a June OPEC meeting come up as well. They will have the April postings out there. May will be out there, and so June, we'll see where things play out. But right now, it seems like consensus is at least 3 or 4 months minimum.
So, Colin, let me ask you: all the solutions that everybody's throwing out, from $1,000 a person to, we've done some things already like SPR, and there's interest rate cuts and quantitative easing. There's all of these things. Is any of that going to work? And what are some of those things? We may employ them now. They're going to have knock-on effects later, good, bad, and indifferent. What do you make of the solutions that are being kicked around?
Well, it's certainly more than a day late and $1 short, for sure. For months, we've been warning clients that overnight liquidity markets and commodity options data were just waving these really serious red flags of a coming tsunami for commodities, equities, and credit. And it was for the reason we just gave, that there was so much debt on these producer balance sheets that the system was basically begging the producers to cut volumes. And so what the purpose of the forward curve is today, both the spot price and the term structure as you look out into the future, is to make that happen. So, I think we've already said that if you give $1,000 to somebody, that doesn't, give them a vaccine. It doesn't bring their loved one home from spring break on an airline that's not flying. So in the very near term, a lot of those factors are not going to be very effective. But as we look out 3, 6 months, we are talking enormous amounts of liquidity. And so if anything, we're going right back to the problem that got us into the situation where we had the repo market and others warning that there was too much liquidity. And so I think the open question is, when we go through this sequence again down the road, whether it's a year from now or whenever it is, are we just setting ourselves up for another credit-fueled problem?
Matt, one question for you. Looking at your coverage universe and people's hedge books and what they look like right now, what's your takeaway about the status of those?
For 2020, the vast majority of our coverage universe on the oil side has a decent amount of hedge protection that is somewhat insulating the capital program this year. The real issue that occurs is in 2021, within our coverage, less than 10% of the production on the oil side is hedged. And so you really truly get exposed to the spot price dynamic. And I think that's really where, as we get into the back half of 2020 and going into 2021, we're really going to see these capital budgets come down pretty aggressively to move towards a cash flow neutral spending program. And again, I think that the key message to investors in this market and what's being relayed to the industry is do not add any incremental debt. Really focus on trying to maintain as much liquidity as possible and really work towards, over the medium to long term, structurally fixing some of these balance sheet issues. I think that the message that clients have really kind of pushed through the industry over the last few years on balance sheet repair is going to come home to roost. And as we come out of the cycle here, we could see an industry that is thinking about leverage in a whole different way that could really kind of structurally change the way the businesses are being run.
And I'd add in there too, is like, it's not only the level of hedges, it's what kind of hedges they have in place.
Yeah, I'm glad you mentioned this, because in one of the producers that put out an announcement today made the comment that they had easier to understand hedges, I think was the expression. Can you comment on that? Because this does seem to be, I mean, it makes sense that investors appreciate investors.
If you look at most E&P firms, they're either using swap, two-way collars, or three-way collars. And the issue right now is the three-way collars. It's exposing a lot of guys. It was a cheap way of getting insurance on. And what it's doing is it's exposing them to the downside, because they're basically short puts on crude oil. And so they're not as protected as you would think they are. And that's the difference between some of the guys that have and have-nots from the hedge books. People are really looking at how these hedge books are originated and what they look like, and so that's a big issue, the three-way collars.
So one question for you guys, we've kind of been saying this for a while now, which is that the lack of investment in the space is eventually going to come home to roost, and we should see pretty attractive oil prices a few years out. We were saying that 6 months ago.
Yeah.
Do you guys think it's absolutely the case now, or do you have more optimism about oil prices a few years out now than you did before all this started?
I would just start out and say that, yeah.
Weighing there on the producer front, to give you a little bit of context, in 2019, as we were looking at the vast majority of our coverage universe, especially in the mid-cap space, most operators that we cover were not capable of actually generating free cash flow in any material amount at $50 crude. And so I think the punchline, as we've really dug into the sector over the last few years and kind of truly looked at full cycle costs and the cash flow economics of this business, below $50 WTI, the vast majority of this industry doesn't work. And so as we kind of think about the longer term dynamic, and as you start to skinny down the sector into a more consolidated nature, I think that's at least a good price level to be thinking about in terms of where these business models actually start to at least be self-sustaining. And then the real question, I think, over time is kind of what the call on the U.S. Could be as we start to tighten up the global supply over the next few years.
Okay, well, I'm trying to pin you guys down like a good reporter. Does everybody feel more optimistic now about better oil prices a few years out than they did before this started?
I would say yes, simply because the global capacity. I mean, well, basically the surplus capacity is going to be taken by OPEC. The U.S. is not going to take that. I think the back end of the curve is going to be better supported going forward.
Ken, how do you feel?
Well, I don't necessarily sit in the same camp y'all do, so I will say that I thought this is just based on where we've done, the $50 to $60 window was probably the long-term window for a while. And that's basically reflective of a relatively flat supply curve, just to be blunt. So looking forward, I think we'll get back to that point. I think what we're seeing right now is an acceleration of that Darwinian prospect that I mentioned earlier. I think we're setting the stage for a pretty strong surge in demand maybe in the back half of 2020, depending on how rapidly this coronavirus issue abates.
Colin, anything you'd add?
Yeah, I think the relevant numbers are that we're looking at maybe a 5 million barrel per day supply cut that needs to get done. My own estimate is we probably need 3 million of that to come from the U.S. On the liquid side. And when we look at the options and the futures, all of the damage is very much focused at the front ends of the curve. For example, the JO contract that's going to expire 3 days from now is very tight around current prices. But it also looks to me that what's really happening there is algorithmic trading. And so the computers have assigned a significance to the 26 price level because 26.05 was the low back in February of 2016. So in plain English, we're basically seeing everything getting concentrated in the second quarter, but both futures and options are very resistant to the idea that that should be priced into the forward contracts for all the reasons that Matt just gave. So to give just one number, if I look at the January 2021 contract, the market believes that price will expire at $49.60. That's $15 above where the forward curve settled today.
Let me wrap up with one last question, Ken. This is a hard one, but you know, what's been crazy about this environment that we've been in, even before it got really crazy, is at the same time that we have all these financial pressures and are doing so much to change our business. You know, there is in this the backdrop of oil and gas has got to get cleaner. We are, you know, over time, perhaps going to use different sources of energy. No perhaps to it. I mean, that's been the drumbeat. What does this do to the conversation around using less oil as a social objective?
I think it moves it down the totem pole. And that doesn't mean people aren't going to still sort of carry that drumbeat with them. As a matter of fact, you know, at the onset of coronavirus in Europe, the EU is passing legislation to sort of adopt, you know, European Union-wide standards on decarbonization, et cetera, et cetera. So, you know, all this stuff is still moving in the background. I think what this is going to do, though, is really highlight the extent to which anything that is done from a policy perspective might actually give some burden macroeconomically, because everybody's living through a downturn right now.
Right.
And that puts it right in your mind's eye. So if you then do something that might trigger a similar sort of response, policymakers are going to be very, very attuned to that.
Right. I think this is some of our Canada team has, of course, in Canada, the politics of all this is even more intense, and that's something they've been saying, which is when you get a visual on this, it makes you less likely to want to push for it voluntarily, so to speak. That's through policy.
That has a lot to do with it. I will say this, just because we've talked a lot about supply side adjustments and where demand might go, but there's an interesting thing that's happening in the sectors itself as well, I think is also important. This has become a massive HSE issue for companies operating in the upstream. And I commented in a previous conversation that this might actually trigger a more rapid adoption of automation in the field. But I had a conversation with one of the largest offshore upstream service companies, and they were commenting on how they cycle workers on and off rigs in Africa and other places around the world, and how they've got contingencies in place because the last thing they want is a coronavirus outbreak and make a rig a quarantine zone. So these are massive issues that these companies are dealing with that go above and beyond what the current price of oil is, because this could spill over and have longer term effects.
Let me wrap up, go around the horn, and just the general question is, anything in today's world or today's market that we should have talked about that we didn't? Matt, anything from you?
I think the one other topic that's really kind of coming up with a lot of frequency is what the long-term cost of capital will be for the upstream space. And that's still a big unknown, but clearly with how the market's reacting, I think the hurdle rate for investment going forward is going to be significantly higher. And I think investors are going to be looking for companies to run their businesses, even in a recovery scenario, with significantly lower leverage. So this could actually have a pretty meaningful structural change to the capital allocation strategy for the industry over the next few years.
Okay, great point. Colin, from you?
I think it's always useful to have roadmaps on where you're going. It helps keep your mind dispassionate and data-driven. So I have two. One is keep an eye on the time spreads in the WTI market. Right now, they're indicating we're either in a very severe financial crisis and or global recession. If that begins to move back toward a zone that looks more stable and bullish, that will be a really strong confirmation of where we are. And the second is, with all this emphasis on a flight to safety, the US dollar in particular, I'd keep a close eye on Bitcoin because it has gotten walloped along with every other global market price. But if it begins to move upwards, that's going to be your indication that all of this largesse, these trillions of dollars being thrown at these markets, are beginning to have an effect on the inflation of asset prices.
Okay. Mike, anything?
I just think everyone is, investors and companies are on the defensive. I mean, it's a little bit early to ask, what's the normalized environment look like?
Yeah. And
what does that mean for M&A and who survives and who doesn't? We're not there yet, but it's interesting to start to think about that, as an investor and in the boardrooms, how that's going to play out here.
Ken, we'll close with you.
So I'm going to kind of close with a question because I think it's an interesting thing to think about. I like Colin's point about having a roadmap, staying in the data, but I heard at a recent presentation that the share of acreage owned by majors in the Permian prior to 2014 was in the order of 12%. And today that's around 25%. I haven't verified those numbers. You guys can certainly do that. But the point was being made that in the last downturn, it actually triggered an opportunity for those firms to expand their footprints. And I wonder if this might not do a similar sort of thing. And thinking longer term about what that means for capital discipline in the sector, I think it'll be better if that's the case. But looking at what OPEC decision making might be in light of a larger major footprint in the shale space, I think that could temper to some extent what OPEC will be able to do to the market, because you're talking about a relatively robust source rock, which is not going away. And if you can get companies to do that much more efficiently, it might actually change the game in ways that many people were anticipating shale might change the game.
All right, well, there was a lot in there.
Yeah.
Thanks so much to Ken for joining us. Matt, Colin, Mike, thanks as always. Thank you. Sorry we went a little long, but with these brains, it was hard to rein them in. Stay strong out there and stay safe. We appreciate you guys, and we'll talk to you soon.